Happy Easter. And for those of my Jewish friends, hope you're having a good Passover. Certainly it was a different Passover in my family without the big get-togethers. I titled today, which is 4/12/2020, Did the Fed Put a Pillow Under the Dead Cat Bounce? My name is Jeffrey Scott, and my email address is hgsidoc@gmail.com. If you are watching this on YouTube, if you hit the subscribe button, you'll be notified when I do additional videos. If you drop show more, you'll see a link to a Dropbox file, which is 4K if it's not clear on YouTube. Remember that YouTube has reduced the base resolution. You have to go in the lower right-hand corner of your video, click on the gear, and then change the video to the highest resolution you can support if you're watching it on YouTube. When I mentioned the comment about the pillow, first I put a floor, but the floor is kind of hard and the floor probably will stick around. But a pillow is fluffy and you could push it further lower. So I called it a pillow. So here are the futures at 4 a.m. where my cursor is, with a fresh sell signal on Thursday, because we ended on Thursday, falling into the 8:30 hour. It looked like we were going to have a soft open, not a shocker. It had been a very, very strong week. And then two things happened at 8:30. Employment numbers showed, I believe, 6.9 million new claims, which is a whopper number, depression level numbers. And then immediately the Fed acted and released, I think, $3.2 or $2.3 trillion more of help for small businesses. The result was a massive rally in the S&P and other indexes, and then a pretty much sideways move during the day at the end. There was a period in the mid-afternoon when it looked like the market was going to give up a substantial part of its gains. I actually watched my day turn negative during that period of time, which I was disappointed. But before I could blink, the market moved back up and finished positive on the day. The end of a very strong week. For those who don't know what I'm using here, this is what I usually look at the markets with in TradeStation, among other things, which the arrows are John Person buy and sell signals. The dots are from Alexander Elder. When they're green dots, that suggests MACD divergence and that you have a reversal coming. You can see that as the market got lower and lower, right here the MACD histogram actually turned positive. So that gave some warning that you might see a flip. When you see them up at the top, it starts to give you a warning that the market's probably going to roll over. And you could see here that despite higher highs, the MACD histogram was lower and lower. This is an Elder envelope. Typically indexes and stocks don't spend a lot of time outside it. This is my bongo, and it will match the current time frame. And then if it's a daily chart, it'll give you weekly and monthly. Here it's a 5-minute chart, so it just tells you the current time. And this is my high jump, which really only became an issue up here after the big rally. Disclaimer. This session is for educational purposes only and recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I am not affiliated with any software or trading company. I pay for the tools that I use, and no one pays me a commission or gives me any share of your purchase if I introduce them to you. Trading involves risk. You and your owner are solely responsible for any investment decisions you make. Like everybody else, I listen to tweets, television reports. I have my favorite videos I watch, like CCM, money management guy from Atlanta. And, the vast majority of people I listen to are calling for a retest. I think a retest is likely too. But I just wanted to point something out. This is not the same reasons for the market pullback of the Great Depression, nor in 87 or in 2001 and 2 or in 2007 and 8. This is different. The last time we had a worldwide pandemic similar to this was 1918 to 1920, the Spanish flu. 500 million people were infected. of those 500 million people, about 1 in 5 or 100 million died. We're at 100 plus thousand, so it's a little bit less now. The markets improved before the pandemic started to recover and went on to new highs before the depression. The worldwide economy, especially the U.S., were in good shape at the record high markets at the start of the current pandemic. We need to be careful, I believe, comparing this bear to other bear markets driven by pure business and banking failure, credit failure. And since everybody's expecting a retest, including me, and a potential lower low, we may not get one, and markets can go up or down. The correction here was 33.5%, very similar to the correction we saw. And notice how by the end of 2018, the market had bottomed and turned around, even though the pandemic was far from over. I always like to call out folks that I learned from. I started with Canceling with William O'Neill, Improve My Morales and Catcher, Take to the Computer by Ian Woodward. Ron Brown is his partner, or was his partner before Ian passed away. George Lee, who recently passed away, a great trader for the Canadian Northwest. Van Tharp, the king of position size and money management. Cigar from Superior Profit has got some great tools that you'll see on my next TradeStation screen that I use. And then John Person, who also has some great tools, some great books, great training, become a good friend of mine as well. I own a lot of programs. What I really need in my desert isle are my TradeStation Think or Swim, my Q-Edge tools, which this version didn't have on it. But other than that, it's really about HGSI and EdgeRater. If you don't know HGSI, the software package, which I make no commissions on, I don't own it, you click on the free 30-day trial. They don't ask for a credit card. You click on investing strategies, whether you've logged in or not, and they'll give you access to a large number of videos that I and others have done. Ron Brown does some great videos. John Person recently created an add-on for HGSI. It's a separate purchase. I think that's $727-ish. And the introductory price is at least extended through April. It may be extended through May. I'm not trying to bait and switch you. I'm not sure what it's going to be. It's $727 a year. And then on Thursday, I did a YouTube video with Dr. Keith Wade from SeasonalTraderPro.com. He has some really great tools. And if you go to YouTube and look me up on 4/9/2020, you'll see where it says show more. You'll see links to his deals. And if you watch the back half of the video, you can see how he uses them and how I use them. Stock patterns are cyclical. For a number of weeks in late February, early March, it was easy. We were down. We were selling off hard, and that was an easy market. The last couple of weeks, we've been going up a lot. I mean, at some point, we've got to get to uncertainty, and I'm getting more uncertain as we get longer and longer in this bear market rally. And as you could see here, how I affect the market is driven by what the market is doing. I've made a fair amount of change over the last couple of days or weeks as I took a more long, although safely long posture. But we're starting to get a little bit longer in the tooth. And just to talk about that very quickly, this is another TradeStation chart. And this TradeStation chart, I guess that's the best it's going to do me. This TradeStation chart has E-mini futures, NASDAQ futures, Dow futures, and Russell futures. It shows you the sell-off. And then a fib retracements off the bottom. And what I wanted to point out is we're at about 50% installed on the E-minis. We got a little bit above 50% retracement on the NASDAQ and got a doji. We stalled at the 50% retracement on the YMs, and we only made it, I believe, to the 38% retracements on the Russell. So we've had a dynamic move off the bottom, Is this the beginning of a V bottom and do we go to new highs? Or is this the beginning of the do we retest from here, make a higher low or a lower low, and then go on? I'm still in the retest camp. I think this is a natural area for this bounce to fail, but I'm open-minded and I'll play the market the way that I have. You'll notice at the top across the board, you see these crosses here, big red dot here, crosses here. At the bottom, you see the crosses, the cross, cross, and the dot. Those are from Sagar's tools, and they represent markets that are stretched or facing a headwind where you start to expect a reversal. And sometimes, as you could see within here, you get short-term reversals, and sometimes you get the big reversal. This here is a Roy Kelly cycle finder, and I'm really only paying attention to the ones that have the red line. It called the peak on every one of these markets. I thought there was a peak on this one further to the left. It was up here. And then the market went sideways for a couple of days. You don't get the red line very often, all right? This is a daily chart. You don't see that red line. Even on normal pullbacks in the market, as we saw in May last year. So the fact I see that red line in the middle of the triangle, stop. All right. The fact that I saw that red line in the middle of the triangle to me is a very important sign and got me aware that the markets were ready to correct. You'll notice at the bottom, again, I have the red line in the triangle on each of the indexes. So one thing I'm watching for are to start to see at the top of this recovery circles, plus signs, or the triangle with the red line. These are considered major cycle tops and major cycle bottoms. The ones without the line are more minor cycles, and they're meaningful, but in this market, I'm looking for the ones with the red lines, which don't occur very often. Intraday, I'm sitting with these tools, and I'm watching the market on a 15-minute. And the neat thing about these tools is they are fractal, so even on the smaller time frames, I get a sense when there's major changes coming into the market. Let me just close this thing down there. All right, so you have to approach the market with what you see in the cycle. So I'm getting more and more cautious, but we're still in a recovery phase or in a rally phase. If I look at the sectors on Friday, you can't see it here, but the one that was the weakest was technology. And the SOX was actually negative, I think 2.3% or so on the day, which was interesting because technology and finances were some of the leaders of late. Energy also from a sector performance lagged on Friday. It was kind of all over the place. Energy's over here as the oil market rallied significantly and then it pulled back on the on-again, off-again OPEC deal, which I think is on again now that the U.S. seems to be paying money to Mexico for them to reduce production. Major markets tell a story, and I don't think I need to get into the individual slides, but what you can see is whether these are the E-minis, the NASDAQ and the Dow futures on the top, the Russell futures on the lower left, the VIX, and then the dollar. What do you see here? Well, you notice first on the top, you see lots of green signals, bongos, etc. You have a market that's had a nice move off the bottom. Interestingly, you've retaken the 200-day moving average on the S&P 500. You have not retaken this average on the other indexes. Excuse me, not on the S&P, on the NASDAQ rather. So the NASDAQ is leading, followed probably by the S&P. The Russell's the laggard. Another thing you might want to notice is that the volume on the way down was greater than the volume on the way up. That's always a little bothersome. I'd like to see the big volume on the way up. You'll notice here on the VIX it's come down, but it's still very elevated compared to where it's been. We'll come back to this. And the dollar's kind of in the middle of a pattern. On the weekly charts, you could see that the 50 weekly is retaken by the NASDAQ, and you could see how the E-minis really retaken the 200 weekly. The Dow has just retaken the 200 weekly, and the lagging Russell's even well below it. We had new highs in this market where the little balloon is on each of the major indices. The balloon back here was 2018. We had on the Russell, so it's been a long time since the Russell had seen new highs. If I like to look underneath, hard to see, you'll have to trust me, that both the 10-year and 30-year interest rates have moved higher. They're still low. You can see it's where the boxes are, is where they are today. But they're off record lows. I think that's a positive sign that some of the stuff that the Fed is doing may actually be helping. It's kind of disappointing that they've not moved further. Both the small stocks and the large stocks, both the index in red and the AD line in white have turned up. If I look at the NYSE, you can clearly see that the AD line's turned up, as have all the major ETFs listed here. I think the only ETF that turned down is this blue one, which is the bonds, rising rates, falling bonds. If I look at breadth, stocks above the 200 have taken out and have sort of to separate itself from what we saw in 08, 09, where it's actually moved up faster. That's a positive sign. And the stocks above the 40 moved up quite a bit. Perhaps the biggest change is if I look at the 3-month new high, new low, which is only a signal at the extremes. You had a massive increase in this, showing that at least on the short-term perspective, the markets have picked up some steam. The daily McClellan, if you want to be optimistic, you could look at the McClellan oscillator and look back and see the last time you peaked or you had highs like this is you were after the bottom. So that might be a positive thing. But on the weekly McClellan, if you look at the summation index and you look at when the lows in 08, 09 follow, and if you go back further to the left, you'd see that you usually bottom before the market finishes falling. So this might be a mixed, where on the daily suggesting we've already seen the lows, and on the weeklies that maybe we got another test coming. Again, it's not just the experts that are perhaps confused, it's also the market. We are in short-term bull mode, we are in intermediate term bull mode, but in long-term mode, we are still in a correction. So we have to see which wins. Do we flip to a longer-term bull, or does the short-term correction pull down the shorter and or the long-term correction pull down the shorter and intermediate term trends? In a retest, that's what you'd expect. The buckets on the right, if you go back March 16th in the heat of the pain and misery, 99% of the stocks in the S&P 1500 were below the midline of their Bollinger Bands, and 60% of them were trading below their Bollinger Bands. I think there was one where it was 80% as well. If we look at Thursday in lieu of no Friday, 96% of the stocks are now above their Bollinger Bands, although we're not on excessive amounts. So 96% are above the midline of their Bollinger Bands, although only a small number are above the Bollinger Bands. So we've certainly gone from a bearish to a bullish posture. I might even call extremely bullish posture, but not to the point where we are clearly overextended. One would not expect a HINDY to fire, and it didn't. And if you look down here, you could see you actually got more new highs than new lows, but the numbers are all very, very small. Market tone last week, I was a little bit surprised to see how bullish it was. Well, it should have told me that we'd have a great market, and we did. We are in a very bullish posture on the short-term frame right now. Lots of volatility and risk, which is why the red and the black here. So be on your toes. And even the sectors, even though energy was down on Friday, if you go back and look over a period of time, it's been up. You can see that all the sectors are green here in the Woody indicator as well, with the volatility issue. Now, as I was patting myself on the back, say I had a great week, what a wonderful market, I ran this report. Now, let me tell you about this report. This is called a group performance analysis. It's a standard report that you could run with about 5 clicks in Hgsi. And I keep a bunch of lists every week. And part of the reason why I keep them is so I could see how things are doing. So I have in here somewhere my current holdings. So I was 21 wins, 4 losses, up 8.42 per, 38 and 7, up 9.2% on the week. I'm happy as a clam. Interestingly, my 9.2% trailed the S&P, which was up 12%. But if you look at the MarketSmith 250, it's up 5.14%. The weekend review stocks were only up 2.56. The IBD 50 is somewhere in here, was up about 7.6, about the same as mine. If I looked at the stocks that I was interested in buying, they were kind of flat on the week. And that's, I was up 2-to-1 on winners to losers. But that's, if you remember, I was sort of mixed. I had a lot of contra ETFs that would have pulled my performance down. I don't buy them just because they're on a list. I put them on a list, shorts and longs, to watch. The interesting thing is, look at what was the leaders. Stocks and groups moving to the downside. 97% of the stocks that were in a bearish group were up with an average return of 49%. These are calculated by HINDY. Potential short sells. 99% were up, 31%. Stocks and groups moving to the downside. These would be higher cost stocks, 99%, 28%. Negative earnings growth, 27%. Weekly LCDs, 26. OT. What does this mean? This means that this was a week where the laggards tried to catch up. Is this rotation? Perhaps. Is it a one-week phenomenon? But junk led this week, despite all the positive things in the market. Now I can do a similar thing in EdgeRater called the warehouse report. So I took the fundamental values on the beginning of this session, would have been Friday, end of day on the 3rd. And then I took those values and I used EdgeRater to show me return versus some of those values. Now ERG stands for EPS rank plus relative strength rank plus group rank. The highest you can have is 297. Higher ERG stocks are growth stocks and are the stocks that I typically buy. What this curve here tells me is that you have the highest gains. This is 1 week gains over 30% on stocks with ERGs less than 100. All right. Even on the stock, and I ignore the head and the tail because there's very few stocks. So I usually start about here. All right, and about here. So you had a good return as well on high growth stocks, high ERG stocks, but this was a junk off the bottom. If you look at EPS rank, no earnings did better. You look at relative strength, lower relative strength did better. If you look at stocks on accumulation distribution as they were sitting a week ago, the distribution stocks did better. So this was not a typical bullish looking week. This was a great return week, but boy, did junk play a big role. Canaries in the coal mine, you bounced. I think we fell 40% and we bounced 28% off the bottom. But we're awaiting earnings. I expect this to go sideways, maybe a little trend higher over the week until we get next week with the earnings for the big players. As I look at the news for this coming week, retail sales are going to tank because it's going to include March. We expect that. Industrial production probably could be low. Inventories, they're expecting them to be, well, we'll see what they are. They're probably going to take a hit because of channels. Home builders index at some point is going to fall. And the beige book's going to probably reflect a lot of weakness in the market and going forward. Weekly jobless claims, pick a number, 8 million, 10 million, 7 million. Housing starts are going to be poor. I'm not sure how much that news matters because we know it's going to be horrible, although it might be the first glimpse, but not a full glimpse of what we're going to get because of the coronavirus shut-ins. Earnings, you'll learn a lot from earnings. These are tough earnings, and they're tough earnings because first you're going to look at actual earnings for this quarter and revenue versus expectations. And it's not just the expectations that are published and what are the whisper numbers. Then you're going to have to hear earnings and revenue for the next couple of quarters. And what you're probably uniformly are going to hear is we're not giving guidance. And then probably in a small number of stocks, the earnings performance will be good enough to propel them higher. But I suspect a lot of stocks are going to suffer from the I don't have a good feel of where the earnings are going, therefore I'm going to mark the price down itis. And that I think this is going to be a tough earnings season. We'll see. This week, Amarin is a pharma stock that's been up and down. It's been clobbered because it seems that they've lost some patent protection. J&J may give us a hint of what's going to happen in the big biotech and pharmas. We get a bunch of big banks, Wells, Citi, Goldman, Bank of America, JP Morgan, I believe, are this week as well. So on Tuesday. And we get a little bit of retail with Bed Bath & Beyond, but that's been a pretty much taken in the dumps already for a while. And then some energy with Schlumberger. I think it's going to be a very interesting week. But like I said, these are going to be a tough time of earnings because how much visibility do you get going forward, especially with no end in sight yet on coronavirus? And if there's no visibility, how will the market react? My thoughts, we ended the week on a high note as the Fed comes to the rescue with a new $2.3 trillion package, putting a floor or pillow under the falling futures on Thursday morning. Major markets were up over 10% on the week as bounce off low continues, with energy the only sector down on the week. These are the numbers year to date. Hopefully you're back to neutral or higher, but you could see the Russell still down 25%. The market rise was led by beaten down stocks hoping for a federal bailout, not necessarily quality, which is concerning. As I said, I still listen to folks, and a lot of people are still calling for a double bottom, yet the longer we rally, it's harder to resist the FOMO. Every day, one of my neighbors asked me, have we hit a bottom yet? I've told her to go in already a little bit, and I went in 25% on the first thrust up. And then after the little flag, I went in another 25%. But I'm going to be quick on the sell button if I see one of my signals, that plus or the big dot or a major cycle, as I showed you on the daily charts. Earnings season starts this week with the money center banks and regional banks. It'll be interesting to see the impact of COVID. I have added to longs, but still have my 2100 put coverage on my Amazon. By far, Amazon's my largest position. Has a significant overweight in my portfolio, so despite the move up, I've kept my puts into earnings. Now, I pay for these puts by selling lots of premium against them, so they really are not expensive puts, and I've had these since Amazon was above 2100. I'll probably take profits on any unprotected positions going into earnings, raising cash, and happy to buy them back afterwards, whether they're higher or lower. I am still in the dead cat bounce camp and retest, but I will trade the markets I have, but I'm ready to reverse quickly. And this is not a buy and forget. It's a fast market. All right, so that used up a lot of time. We're already at a half hour, but this is about the market more than anything else this week. Speaking of the market, let me just go back into TradeStation for a second. And let me pull up a view that I usually use. And I just want to look at the S&Ps, and when I said short-term and intermediate-term bull, long-term bear, this is the S&P futures, and you could see that they went positive 4 trading days ago, which probably was Monday. This week we went positive on the weekly. We are still clearly negative now for 3 months in a row, for 3 bars on the monthly, this being the third bar. That means we are in a long-term bearish trend, and these are counter-trend rallies. That's all they are. Until I start to see my Bongo weekly turn green, till I see a buy signal on the S&P monthlies, I will continue to feel I'm in a counter-trend rally, but I'm going to wait to see reversal signals before I unload. What will that reversal signals be? It might be these red dots. If I start to see them coming in, it will tell me that I've got that divergence. If I start to flip to bearish on the daily, I'll be concerned. If the weekly flips, I'll be very concerned. And as I mentioned before, I have a lot of other signals that I look at as well. And I'll be looking on probably not as much on my intraday pictures, but I have a daily chart running at the same time. And I will be watching for these pluses and circles and person buy and sell signals. And I'm especially looking for this, the cycle with the red line in it. All right. Let's take a look in Hgsi at the markets. Put my top-down view on this. Well, it's probably Ian's top-down view. First of all, you can see in green, very strong week for the major markets. And if you look at 5-day performance, everything above utilities, that's utilities, industrials, gold, transports, NYSE, small caps, mid caps, Russell 2000 were up above 10%, as was the 1500 and the 500. A very strong market. The NASDAQ up about 9%. A very, very strong market. But you saw what I showed you, a couple different views of the junk off the bottom. Just in case you're questioning my resolution, if it's blurry, just want to add, it's a little late to say this, I am in 4K, and my Dropbox link, which will be under the show more, allows you to download the video from YouTube. Or from the email that I send out, and you'll get a 4K resolution video. Will be much sharper there, just to point that out. So let's go to the S&P 500. As you can see, we are right around the 50%. Now let me clean this off and talk about what I think the market could do. So there's 3-road scenario. Let's talk about that. Road number 1 is, we come up, maybe we stutter step here, and we go on to new highs. That would be awesome. Probably not too likely. Road number 2 is we continue to chop around in this area in between the moving averages. That is not unlikely, nor is it unhealthy. And then we either resolve to the upside or we would resolve to the downside. I think this number 2 scenario is the most likely scenario. Number 3 scenario is we come down here, maybe stutter a little bit, a few more, shake in a few more bulls, and then we go and retest. Those are the 3 scenarios we have. Only one of the scenarios do I want to be very long in. I'm shooting for this middle scenario, but I'm aware of both the other 2, and I'm going to try and not be late and figure out which way the market decides. It's not up to me by far. It's up to what the market wants to do. So not a whole lot to say, except on Wednesday we had another Eureka come in. These are 4 bullish signals coming in. That's something that might put me more in the bullish camp than in the retest camp. But I too have to look at prior bear markets, and even though they're different, I don't ignore them. So it'll be interesting to see what happens there. I can look at all of them. I'm not, because they're all pretty much the same. I will look at the NASDAQ very quickly, because you'll see the NASDAQ is actually, not the futures took out their 200-day moving average. The NASDAQ ended up with a doji here, and that's interesting. It's an indecision day. Despite the big move on the Fed, there was a gap up, and it closed in the middle of the range. But that's an indecision day, and Bigelow would say if it opens higher, it's going higher. If it opens lower, it's going lower. And I would expect some resistance in here. I mean, you've got two heavy moving averages over there. So we'd be lucky for us to bounce around and then go higher. But that also could be the place where the this market rise ends. Skip the rest of the indexes because they look similar. The dollar peaked, came down, and now the dollar is sitting right above a confluence of moving averages. It's pretty much in a sideways range, and frankly, except for this little peak here, it's been in a sideways range. With the dollar coming down, it might be good for gold, and gold certainly has had a move up. And if I look at gold miners, which have been lagging, and unfortunately I've been spending more of my time in gold miners than gold itself, gold miners had a very big week. Gold miners off this low here to this high, 10% move already. Imagine if you were in Nugget from down here. Nugget did not perform this year. It's supposed to go up earlier in the year, and it did not perform. Gold is working now. Silver had been lagging gold and looked a lot like gold miners, and it's still lagging, although it's moved up quite a bit as well. Something that is irritating is the VIX has come down, but if this was a stock, would you be thinking of buying it or selling it here? Clearly, the short-term trend is lower, but you're pulling right into support at the 50-day moving average, which would be a natural bounce point. So we'll have to watch that this week. I'd be much happier if and when we get down to this level. If we switch into industry groups, there's 175, and if I go to force index down and up, you'll see a big change from last week. We now have 109 groups to the upside. Look at the 5-day performance on these groups. 28.6 on mortgage finance, 29 on restaurants, 55 on cruise ships, 29 on specialty apparel, 39% on department stores, 26 on auto retailers. Anybody have any word for these? These are laggards. These are the things that have been getting killed that bounced. We have 109 to the upside. 2-day down, we have 1, integrated oils, which were still up a tad on the 5 days. If we look at the medium term up, 5-day up, we have 110 groups. If we look at the 5-day down, which had been the dominant group, none. So that just shows you that we've gone from just a short-term rise to an intermediate term. Still a little bit concerned about the longer time frame. Now, typically, although this is already at 39 minutes, let's look at the first bunch of these. Right-click on REITs, American Tower. So the first couple, these are cell towers. And we're going into 5G. And I haven't heard anything about AT&T and others not being able to pay their rent. So these broke out today, all-time highs on American Tower Corp. It pays a small dividend of 1.5. I've been talking about this thing for months. It's a nice long-term holding. It's a very lower left, upper right steady pattern. It did get shaken out here with the market, but it's moved back up. I like American Tower here. Hard for me to believe that Simon Properties, which is department stores, but there are shopping center REITs and department store REITs, hard for me to believe that they are moving up, but there must be talk of bailouts. Not exactly my favorite area. Prologis, they do distribution and warehouses, big, giant industrial warehouses, breaking out here. What companies are busy now? The drug distributors, they use Prologis. Companies that send goods out. Great growth rate here, pays a 2.4% dividend. Welltower, this one surprised me that it's moved up. This is healthcare REITs. A lot of the physicians I know are having some financial issues as their volume has dropped. Ventus is a old folks home type of a long-term rehab, etc. Bounced here, but not my favorite. The other one I liked are the ones that do the Crown Castle's another thing like American Tower, 2.8%. Was looking specifically for, you may see it later. Cone is one. Digital Realty is another. They do the cloud-based servers and other server farms. They're another REIT that I've been in for a long period of time. Precious metals. Newmont really broke out this week. On Thursday, a big move up with a kahuna. You know, if you look back, they had mobile breakouts from squeeze for several days, breaking up off the 50. I did not buy this one. Maybe I should have. I bought gold, American Barracks, similar pattern, although not perhaps as many dollars, and it's right up against resistance. If it moves up further from here, I'll probably add to my position. Great fundamentals and those are the two that were higher. I like the next couple, so I'm going to show you Franco, Nevada, break above the 50. Earnings per share look good. And you can look at Kinross if you want a lesser expensive one breaking out. Now, as part of a top-down review, I just continue to go through the industry groups. I usually go through the top 10. Let's look at the banks. These are the small banks. They've been beaten down. And you could see, 3 kahunas in the last 5 days with the Eureka, flip of the person market catcher, a mobile breakout, pays a 4.9% dividend, Trust Financial. PNC has earnings this week, similar pattern, 4.2%. U.S. Bancorp, similar pattern. Key Corp, similar pattern. You always do KRE, which is an ETF that should look like all the stocks, pays a 3.6 dividend down here. Also had a kahuna and a mobile breakout, which will give you some individual name risk protection. Might be a way to play this rise in regional banks. Mortgage finance, these are again in the bailout camp, and you could see move-offs off the bottom, 26% for new residential. Annaly Capital, 16.5%. American Capital Age, 16%. Ladder Capital, 16.7%. Why are they bailout candidates? Because they're going to get money from the feds because they're letting people stiff them on their rent. I think if I was a renter under normal circumstances, I would be afraid to ever not pay my rent for long-term impact on my credit report. And I wouldn't want to be thrown out of my house. But it turns out the pressures from the government are on lenders to accept and ignore non-payment of rent. And, they'll just get tacked on the end of their mortgages. And there has to be some financial consideration coming to help these companies. I saw today in the paper, excuse me, that Donald Trump's golf course that he owns, which pays $87,000 of rent to the city of Palm Beach, or West Palm Beach, every month is trying to get some consideration on their rent. I get it on certain areas. That one is makes me scratch my head. So this is one of those beaten down groups that had a great week, but I think it's got to be let the buyer beware. Airlines. Do you really want to go out and buy airlines right now? Well, you want to buy them cheap. Look where United Continental is, near multi-year lows, just off of it. Look at the supply demand. The demand was very high. American Airlines, similar pattern. Delta. Now, normally, Warren Buffett is buying these things when they're low, and he sold airlines. They're kind of haggling now with the government about whether it's free money or they have to pay it back. And the last I heard was for every $10 that they get in bailout, $3 will be a loan, $7 will be a gift so that they can continue to pay their expenses and keep their employees engaged. And of the $3 gift, they'll get warrants to buy stock at the current price on 30 cents or some number like that. So the government will get some stock in the company that they'll have to buy, but at the low rates. The companies will get 70 cents on the dollar to keep. And to me, that's a pretty darn good deal. So we'll see what happens with the airlines. But, there used to be a saying, if you wanted to be a millionaire, invest $1 billion in an airline and you'll be a millionaire when it's over. That changed when Warren Buffett started loading up on them because over the last couple of years with the consolidation, airlines became good businesses. Those days are probably gone for a while. And to some extent, no fault of their own. Tesla, on the auto manufacturers, if I was ever going to buy Tesla, this looks like an interesting period of time. It's pulled back. It's got a buy signal on the weekly. Its earnings are April 22nd. I don't usually buy things like this before their earnings. Now, they've started shutting people down and laying off people or furloughing people. So it'll be interesting to see what they have to say at earnings. Their last quarter productions way exceeded expectations, and one can see a nice rally over the last week or so because of that. Ford and GM bouncing off the bottom. If I needed a new car, it's a great time because they're actually giving all kinds of relief right now. But again, if you just lost your job, I haven't lost my job, but if you just lost your job and are on unemployment, who's buying a new car? If we look at the big banks, big moves, JP Morgan, even more pronounced in the regional banks. You'd expect it to have some issues when it gets up to the weekly, to the 50 and the 200 daily. It had a weekly high close doji, which is a bullish signal, very bullish, but has earnings on Tuesday morning. Bank of America, this is my second biggest position, has put coverage, but it's got earnings on Wednesday. It's fallen from the mid-30s down to about 18. Has a nice bounce here as well. Wells Fargo. I like JP Morgan. I like Bank of America. If I wanted to add to it, I'd probably just buy more Bank of America, though I can't ever argue about JP Morgan. Biotech, sort of a couple different themes in this story. One theme is therapies for coronavirus. So Pluristem is an inexpensive company that has an experimental therapy derived from placenta. It treated some patients in Israel experimentally and had great results. Hence, you had a Bible gap up on Friday and Thursday. On Tuesday, had a mobile breakout squeeze from a kahuna. You could have gotten into it much earlier, 2 days earlier. It's a story without earnings or revenue today. Immunomedics has a new drug that had data come out that was outstanding and likely will get an approval in breast cancer if they're not bought out. If you have a list of biotechs that are likely to go higher or likely to be acquisition and you want to get in early, Immunomedics is one that I've started to buy a fair amount of because of either a buyout or ultimate approval and going to 35 or 40. Biogen has had some Alzheimer drugs. They have MS drugs. It's a great drug company despite a super high price. It trades at a very modest multiple of less than 10, which is a little bit greater than their current, but not their past earnings per share growth rate. No dividend, unfortunately. Novavax looks even better on the weekly because it doesn't have this. When you see your 200-day moving average up here, it just tells you the price used to be a lot higher. They're a flu vaccine and other vaccine company. They've been very active in the coronavirus space. That has caused the stock to go up. I have a position in that one. Don't know anything about Mersana Therapeutics. Broke out this week. So biotech is looking okay. And one thing I'll point out, all this talk about pricing has disappeared now. People realize why these companies are important. That talk will come back. But every day that those pricing discussions stay away are good days for the Biogens and Amgens and other companies that have drugs on the market. Zoom Video, is it done going down? I don't know. It's been a leader in the coronavirus economy. They've had some security issues, which I think they fixed. Look at the demand here is high. Pull back to the 50. You've got a buy signal coming in. I'd not let it get much below the 50, but this might be a time to start thinking about buying it if you want to be in Zoom. Paycom has been another great leader, has pulled back, and I'll say the same thing. It's a small company story, so there's still some risk here, but you're getting a chance to buy it on a discount, and you got two kahunas. That market had a eureka, person buy signal, mobile breakout from a squeeze. That's a very compelling picture. And then number 10 was restaurants. Again, how are these making money if people aren't buying? These will probably get bailouts to help pay for their employees. The money is forgiven if you have less than 500. Well, Starbucks doesn't have less than 500. It's moved up a lot. Perhaps some of this is the restarting in China. All these stocks, to me, depend on how long the coronavirus thing stays. Chipotle moved all the way back up to its 200-day moving average. They had health issues even before we had coronavirus. McDonald's. So these are all been pulled back because of coronavirus as well. So you got winners and losers in coronavirus. Clearly, everybody was a winner this week with the markets, the junk off the bottom rally. I felt bad because the stocks that I put on my potential sales watch list did really well. It turns out all the stocks that looked like they were going in the toilet did well last week. Strange week. I did find a large list of stocks that I was interested in, many of which we've already seen already. Let me just pull them up here. And first thing I'm going to do is I'm going to pull over here. I'm going to change it to a different group. I'm going to change it to, okay. Nope, that's not going to show me what I want. So scorecard, alrighty. Let's look at the industry groups. You'll notice there's quite a few stocks, but not a lot of industries. Application software, Ping Identity is one that my neighbor was in that I was interested in. I hadn't bought it yet, but I'm looking here and I'm seeing improvement in the PMC, a kahuna, person buy, mobile breakout from a squeeze. It's a pattern I like. This might be an interesting time to look at Ping. It's in the internet security. We talked about banks. EverQuote was one of the regional banks I liked. It took out the 50. Unlike some of the others we looked at, this is much higher in the pattern, and it had 3 out of the last 4 or 5 days kahunas, which I like a lot. Number of biotechs looked interesting. There's Immunomedics. If you want a bottom fish on a stock that was much higher, Stemline Therapeutics. Is it done going down? It might be. You have a high closed doji on the weekly. You've got a kahuna here. For those that don't like my grunts and growls, that's my dog who's mad at me because I'm doing this and not giving treats. There's not a whole lot I can do about that. Notice I once did a whole presentation on this pattern. The PMC is getting better. Whoops, wrong way of doing it. When the stock was getting worse, and then you had a buy signal come in here. To me, that's a stock that looks interesting. Got the banks. Pinduoduo is an e-commerce discretionary play. I don't know if it's Chinese. I don't know anything about it. Yep, China. One of the better patterns breaking out here. Virtue Financial I've talked about for weeks. Some of the investment managers look good. This is Ares, breaking above the 50, pays a 3.9% dividend. Large pharma, I've talked about Bristol Myers Squibb several times the last couple of weeks. It retook its 50. On the insurance side, Centene recently merged with WellCare Group, breaking out here. A bunch of mining stocks look good. I showed you several of the REITs I liked, a couple of the specialty pharma stocks. Now, just to show you how I manage that many positions. If I go into, hold on one second. If I go into Thinkorswim, I have watch lists. So I have a buy watch, which puts in these stocks, okay? So I can watch every day what they do. I have some of my favorite signals. This is a old thing I have that is a buy signal. Kahunas, high closed dojis, low closed dojis, pocket pivots, Bible gap ups. And then one of the things I got from Dr. Keith is the daily Laguerre RSI. And that gives me a great signal that it might be time to buy it. Over here is another thing from Dr. K, which is seasonality. If I see a green one, that means in the next 20, 40, or 60 days, I have a return greater than 80%. So Immunomedics has a 40-day return of 19%, 60-day return of 28%. Well, that's kind of interesting. Dexcom, also very bullish seasonality as well. Now, if I can get that with a green signal in the daily RSI, I'm very interested. Now, I take a bunch of my lists, and I call it my extended buy list, and I put it together here. And the nice thing about Thinkorswim, you can detach it and put it on a different monitor. So this is about 150 stocks that I'm interested in this week. And what I'll do is I'll click on this one and bring the ones up at the top, and I'll look to see when I can find one that has the green daily RSI. So we might want to look at, for example, Shopify has a long signal. Now let me, yep. So that should take me to here. I should have shop. And what it tells me is when it breaks above this green, it's usually showing me a time that it's starting to break out. So it's a signal that tells me when it's going to be breaking out, or when it's dropping below the red, when it's breaking down. And on a lot of stocks, I find the initial breakout occurs when it crosses out above that green. On the other thing that I'm looking at here is that seasonality. If I just look at Immunomedics, look at the chart, you could see the seasonality is actually applied. These are Dr. K tools. I refer you to my 4.9 video. You can take a look at that as well. So by using scanners, market watches, if I want to look at TradeStation, it would be my radar screen. I'm able to monitor during the day for signals and take my buys and sells then. On that note, I did get done within an hour, surprised myself. Thanks for watching. Have a great holiday. Stay socially distant. Stay safe and healthy. We'll talk to you next week. Goodbye.